Good evening. I'm Jim Campanella, NMLS number 6311, and sales manager of your mortgage guys at Cross Country Mortgage. I'd like to thank you for attending the very first of 6 upcoming webinars on how to prepare to become a better homeowner and what to anticipate. Let's get it up here for you. There we go. There we go. Okay, there we are. All right, so the first will be on, I want to buy a house, now what? And it's just to give you a basic overview of what to expect through the process, mostly obviously related to the mortgages, but through the whole process. This way you get a good feel for what you're getting into. A little bit about myself. I've been doing mortgage lending for about 35 years now. So I've done a few properties before. I've helped 3 generations of families and hundreds of different people become homeowners. It doesn't matter to the extent of how long you've been in business but more so on the experience level when it comes to a mortgage. It's sort of like going to the doctor and having the doctor telling you that you're going to need a little bit of surgery, and things should go fine, but there may be some complications. You're going to run into that. You kind of want a doctor who's experienced some complications in the past so that they know how to handle it. Same thing with mortgage lending, more so than a lot of the other things, because this is your biggest purchase. This is a life-changing event, owning a house. So you want to make sure you're working with a team of people who understand everybody's situation is unique and help you through it. By the way, real quickly, whether you're on your tablet, your phone, your laptop, there should be a questions and answer box or Q&A box. Certainly feel free to ask questions along the way, and we'll try to make this as informal as we can. Obviously, this is a one-sided conversation because I'm talking to a camera, but maybe we can learn stuff together by some Q&A. The webinar is also being recorded so that you can watch it at a future date. All right, first things, times have changed. Years ago, and again, you don't even need to be a first-time buyer to notice the changes, but years ago what you would do is you would contact a realtor, tell them what you're looking for. They would go to the MLS because you didn't have access to it yourself, look for houses, give you a listing sheet of what's available, and then you'd go out and look at the houses. Once you found the house, you would go to your bank or savings and loan back then and get yourself a mortgage. Well, the times are totally different now. Post-2008, realtors really prefer you working with a lender before they even take you out to see the first house. They want to know that you're pre-approved. They want to know that your situation's not going to hold you back from purchasing a home. So that's really what the purpose of these webinars are for, is to help educate you so you're better prepared. I say often to my customers that knowledge is power. I don't mean to sound corny about it, but it really is true. The more you know, the better control you're going to have over the situation. So the first thing you really need the starting point for buying a house today is pre-qualification or pre-approval. These words or terms are often mixed up, which is unfortunate because it sort of diminishes its value. What a pre-qualification is, more or less, is that you've talked to a lender, they may or may not have pulled your credit, and you've explained to them your income and everything else, and they come up with a number for you on what you could qualify for. It's a great starting point, but it doesn't take it the whole way. And a lot of reasons why it doesn't take it the whole way is, of course, you may not have already provided income docs. So you may say, I make X, but in reality, your tax returns may reflect something entirely different. So pre-qualification is a great start, but what you really want to shoot for is your pre-approval. Pre-approval makes it official. Pre-approval is the start of the mortgage process. We gather the documents, your tax returns, your pay stubs, your bank statements. Take it before, run your credit, of course. Take it before an underwriter, at least here at Cross Country, take it before an underwriter and get you an approval. You're approved subject to some conditions, obviously subject to a sales contract, subject to title, and subject to an appraisal. But now you know that you have the power to go out and make an offer and make a valid offer saying, hey, this is the property I want to purchase. At cross country, we call that a fast track approval. There we go. We call that a fast track approval. You apply for the loan, we get you pre-approved, then you go out and look for a house. And while you're looking for the house, you could be clearing the conditions that are subject to on the approval, so that when it's time to close, we literally can close you within 10 days. Most people don't want to close within 10 days because it usually takes longer for that to get ready to move, but you can close as soon as 10 days. Now, the other thing that I like to mention, which is more important in my opinion than how much the bank or the lender can say you're approved for, is you need to have a feel for how much you want to pay. Because if we come back and say, hey, we can approve you for $1,000 a month, but you're used to paying $600 for rent, $1,000 is a big leap. Now, maybe you can afford it and maybe you're comfortable with that, but you may come back and say, hey, I appreciate I can get approved for $1,000 a month, but I'd rather pay $800. We can work the numbers backwards then at that point. Obviously, if you're approved for $1,000, you're approved for $800, but we can work the number backwards and get you to a more realistic number for you. The other thing to consider, and especially now, depending on where you're looking to buy, I know we've got some people logged in from the Rockford area, we've got some people on the south side, and also in the DuPage areas. When we qualify you, everyone wants to know how much I'm approved up to for a loan amount, which is based on your debts, including the house payment. Your house payment is principal and interest, tax, and insurance. So if we say you can afford $1,000 payment and your taxes, I'm going to an extreme, but your taxes are $800 a month, what you qualify would be $200 house payment, which would be a very small house with very high taxes. If you're qualified for $1,000 payment and your taxes are $200 a month, you could qualify then for an $800 house payment, which obviously is a bigger home. So although every realtor, everybody asks, you know, how much am I qualified for? There's a big asterisk on that. And the reason there's a big asterisk for, well, everybody online today is from Illinois, is because our taxes are so varied. I'm very familiar with the Rockford area. Rockford has very high taxes. When you go up to one of the outlying areas of Roscoe, Rockton, McChesney, the taxes are a lot less. So the same house in Rockford, you may not qualify for that you would qualify for in McChesney. The same goes true Lansing, Illinois. I see some people here from Lansing. Lansing, for some reason, has very high taxes, where, you know, if you go into the city of Chicago, it's lesser taxes. So we have to take a look at that whole picture. And that whole picture then determines really how much you're qualified for. So when somebody says you're qualified for $100,000, that's more of an indicator than an actuality. Okay, so how do you prepare for your loan application? Obviously, it's best to be prepared, so then this way there's no surprises along the path. You're about to make the biggest purchase of your life. It's definitely going to be the most stressful situation that you're going to go through, not just going through the buying process, but through the whole process of, you know, moving in and everything else. So it's best to be prepared. And the more prepared you are, the easier it'll be. What we're going to ask for, any lender is going to ask for, is some basic information of who you are. You know, your full legal name, your social security number, your birth date. In many cases, we do ask for your social security card. We do ask for your photo ID to prove who you are, that type of stuff. If you happen to be a resident alien, we need a copy of your resident alien card. You know, phone number, so on and so forth. In today's world, everything is done via email, so obviously we need your email address. Anything to verify your income. If you're self-employed, that's very important because you know what you really make. Not saying that you don't tell the truth on your tax returns, but you may be deducting certain things off your tax returns that reduce what you make, therefore reducing what you have to pay in taxes. And by doing so, we have to count it based off of that income. So it's important to provide that information. Going again through, you know, the more current stuff would be pay stubs, W-2s, federal tax returns, so on and so forth. All that information is what's necessary in order to determine what your income is. Beyond that, one Once we pull your credit, we'll be asking for things like an explanation for any late payment collections, judgments, derogatory credit, verifying your source of funds for your down payment, and so on. If you had a bankruptcy, evidence of when that took place. The reason for that is, here's the, on your screen now, is a breakdown of the waiting periods required for a prime loan, and we'll discuss the difference between prime and non-prime. But for a prime loan, the waiting period. So if you had a Chapter 7 bankruptcy and you want to go conventional financing, which would be Fannie Freddie, you would have to wait 4 years from the discharge of the bankruptcy. If you had a foreclosure, you have to wait 7 years. Versus FHA is a little more liberal. They have a little bit more lax rules, and it's only 2 years for a bankruptcy or 3 years from a foreclosure. So depending on, again, your unique situation, we may have to look at, if you had a bankruptcy less than 2 years ago, we may have to look at different types of financing than what would be conventional type financing. Okay, the different types of programs, and this is where we were just talking about, is prime loans, or it used to be called conventional loans, and non-prime. We used to have subprime. We don't have subprime loans anymore, but they're called non-prime today. A conventional loan is a loan that's ultimately sold to Fannie or Freddie. Doesn't matter who does the servicing. Servicing is something entirely different. But a conventional loan would be, you can get financing up to 97%. Above 80% requires PMI, which is private mortgage insurance. What private mortgage insurance does is you pay that each month for the benefit of the lender. The lender requires that you have PMI insurance on the loan to protect them from the loan to value that you borrowed to 80%. And what that means is your loan amount being 80% of the purchase price or the value of the property. 80% is the norm. So anything above 80% would require PMI insurance. The minimum credit score on a conventional loan is 620. The maximum debt ratio basically is 45%, although there's some factors that may get you up to 50%, but basically 45%. And you can do that as a fixed rate or an adjustable rate loan. With the way rates are right now, very few people are doing adjustable rate loans simply because they're not much better right now. FHA is a very popular product. It came out in the after World War II, to help all the returning GIs and everything came home and wanted to buy homes. It's up to 96.5% financing. All loans require MIP, which is mortgage insurance premium, not a lot different than PMI, but a little different. Minimum credit score is 580, and that's asterisk because there are exceptions that allow you to go below that. Maximum debt ratio is 55% of your income. The unique thing about FHA today is that it's not really geared for condos anymore. At one time it was, where condo associations went through the process to get approved FHA. Their approvals are expiring, and it doesn't appear that anybody's renewing them. So if you are FHA approved, you really have to be careful in watching whether you're going to buy a condo, because you may not be able to do that. Even though you're qualified, if the project isn't, you're not going to get a condo. It's really geared for more single-family residents. When we're talking about debt ratio, so you have a better understanding, when it says it goes up to 55% of your income, that's 55% of your gross income. So if you make $1,000 a month, we'll keep the numbers simple so I can do it in my head. If you make $1,000 a month gross, your total debts, housing, car payments, everything total $550. Now, the reason I mention that it's the gross, is because in reality, if you're making $1,000 a month, you're paying taxes, you're paying, federal taxes, state taxes, you're paying possibly health insurance. So, at $1,000 a month, you're probably taking home maybe $850-ish, probably $150 going out. But yet you can get a loan to cover up to 55%. So that's where it goes back to what you feel you can afford versus what you can't afford. Just because we say you could afford it, you may not be comfortable at that number, and that's important. You need to make the payments for the next 30 years. You need to be comfortable. If you happen to be a veteran, the VA program is outstanding. It's up to 100% financing. Technically, there's no credit score requirements. A lot of banks have a 620 requirement. We have a 580 minimum, and again, that varies. Below 580, it's a manual underwrite, but we still can do it. The maximum debt ratio, according to the guidelines, is 41%, but you can go up to as high as 50. Probably could go up to 55. The VA has reduced closing cost options. They're fixed rates and adjustables, and you must have an acceptable certificate of eligibility in order to get a VA loan. Great program if you're a veteran. The USDA, for those of you that are on the broadcast tonight in the Chicagoland area, this is a program you can't qualify for. The USDA is for rural America. There are some spots in Winnebago, Stevenson, maybe in Boone County that would qualify. Yeah, there's probably in Boone County that would qualify under the USDA program. It's for certain rural areas of the country. Great program, 100% financing. You can check the eligibility for the property just by logging into that website, seeing if you type in the address and it either is green or red. If it's green, it's eligible. There are income restrictions. There is a 640 minimum, and it allows you to go up to 50%. Okay, those are your prime or conventional type loans. That's where most people get loans. However, everybody's situation is unique. So there's also the non-prime loans, and this would be the non-traditional loans. Example, we can do somebody who's one day out of bankruptcy or foreclosure. Bank statement program for self-employed. We have to have some form of verification of income, but we don't necessarily need your tax return. We can use your bank statements, add up all your deposits, and determine that as your income. Foreign national or ITIN programs are available. Non-warrantable condos that don't meet the guidelines of standard products. With a non-prime loan, the loan to values are lower. They're generally require a little higher credit score requirements. They do have higher interest rates and closing costs, and they come in fixed rates and ARMs. So it's risk-based. These are riskier loans, so therefore the investor gets a little better interest rate. Not something we run around promoting, of course, but if you're in this situation and you want to buy a house, there is an option now available to you. Post 2008, these programs all disappeared. In the last year or two, they're now slowly being unveiled again. So it's really opening the door for home ownership by offering some of these non-prime products. All right, and that's basically the general overview of the products. So then let's say, you go through the process, you get yourself pre-approved, pre-qualified first if you want, and then pre-approved. So now it's time to work with your realtor or a realtor. This is something that I think is missed a lot, but I think it's an important part. When you're working with a realtor, they're either the selling agent or a buyer's agent. And what that means is automatically a realtor represents the seller. They're paid by the seller. So any realtor you work with really's got the interest of the seller in mind, not you. So over time came about the buyer's agent. And what a buyer's agent does represents you. They're there to be your representative. They're not necessarily there to represent the seller. So it's my suggestion always to work with a buyer's agent. Buyer's agent has a contract that says, here, these are the things I'm going to do for you. I'm your buyer's agent. They negotiate with the seller to get paid, so it's not money out of your pocket. But by having a buyer's agent, you know that they're going to be out there representing you. The reason I emphasize this, and there's a couple of realtors online watching, some of our premier realtors are with us today, is you're about to make a very large purchase, probably the biggest purchase of your life. Your real estate agent, who's a true professional, is there to represent you, there to find the houses for you, there to assist you. Now, obviously, you can Google and you can Zillow and you can do everything else yourself to find houses as well. But you want to work with somebody who's got, your interest in mind, who's got your heart in mind, because this is going to be your home. You're going to be living here for some period of time, whether it be 1 year, 5 years, or 30 years. So you want to work with somebody that you feel that connection with. In my personal opinion, they could be a new agent. They could be somebody with a lot of experience. You want to talk with them and make sure they know who you are and what your needs are. And in the same token, you want to make sure that they're representing you. So in my opinion, you should be working with a buyer's agent. Most realtors, would be happy to do that. And, as I said, there's a little agreement that you sign saying that if you buy a house, they represent you. That protects them from you looking at something online or driving by a house at a open house and walking in and buying a house without them. It's, even though that might be exciting, you really want to work with your agent. The next one I want to talk about is your real estate attorney. For those of you in the Chicago area, that's a common thing to use. For those of you in the Rockford area, very few people use an attorney. You're not, in the state of Illinois, you're not required to have an attorney. However, I strongly advise having an attorney. And I also strongly advise you interviewing your attorney to make sure he or she is the right attorney for you. I don't know why the Rockford community does not use attorneys, but they don't, not often, whereas Chicago almost always does. But that's the case. The attorney is sort of like an insurance plan. They're there to protect you should you need it. If the transaction goes perfect, do you need an attorney? Absolutely not. You don't. But anything along the way could cause it, something to stumble, and all of a sudden you do need an attorney, somebody to protect your interests. You're buying this house. You want to make sure your title's clear. You want to make sure that the deeds are right. You want to make sure the seller has the right to sell you the house. If the contract's going to, if there's some terms in the contract that you can't meet, you want to make sure that the legal procedures are followed to protect you. Everything needs to be done in writing in the state of Illinois when it comes to real estate. So even though you and the seller may agree that, yes, it's okay, we didn't close on Friday, we can close Monday, that's really not okay unless you have it in writing. So that's where an attorney comes into value. There are attorneys out there that, is more of a meat shop type atmosphere where, you're just a number, you pay a small fee and they represent you. That may be fine. However, again, I would suggest having an attorney who's actually got your interest at heart. It may cost you $100 or $200 more, but they're going to be there to protect you. If you're going to spend $100,000, $200,000, $300,000 on a house, it just doesn't make sense that you wouldn't want to invest $400, $500, $600 in an attorney, just to to make sure to give you that rest that you're protected. And again, your realtor, your banker, your lender, we all have referrals that can refer you to a good real estate attorney. Okay, this is a question that everybody seems to ask, so we wanted to cover this quickly. What is the difference between an appraisal and an inspection? And that's a good question because a lot of people think, an FHA appraisal is going to be your inspection. However, it isn't. Basically, the difference is an appraisal determines the value of the property. An inspection educates the buyer on the condition of the property. An inspector is not going to come back and tell you if you're getting a good deal on the house based on the value. The inspector will come back and tell you whether you have good water pressure or whether your septic field's about to fail or whether the roof needs to be replaced. The appraiser is not going to tell you those things. The appraiser is going to tell you the house is worth $100,000. Now, the house has to be in a certain livable condition that the appraiser will comment on. When it comes to, especially on the FHA side, there's certain things of requirements like smoke detectors, CO detectors. You have to have your rails, going up and down stairs because that's a safety issue. So FHA does kind of cover sort of some inspection. However, it's not your inspector. You're not required to have an inspection. The lender doesn't need to see a copy of the inspection. That's between you and the seller. But you're buying something that you plan on keeping for a long time. If you're going to go out and buy a used car and you know a mechanic, you'd probably have the mechanic look at the car. Same thing here with the house. You probably should have an inspection done on the house just to make sure that it's good. You are going to get an appraisal done on the house. The lender is going to require that. So an appraisal is required, inspection is not, but in both, you probably want both. All right, so you've made it through finding your house, you're under contract. You've already gone through most of the process for underwriting. So now you're clear to close, or CTC. When you get to that point, you might see the word C or the letter CTC, but clear to close. If you've gone through the pre-approval process, the true process, getting to clear to close is a lot simpler and a lot less stressful. If you have not gone through it, then you're gathering all the paperwork that you're going to need, the pay stubs, the bank statements, and everything else, your homeowner's insurance, so on. Once you're clear to close, you can actually set up a closing. So in a nutshell, what the closing does is it transfers title from the seller to you. The documentation involved at the closing, well, first, who's normally at the closing? Your realtors are generally there. Your attorneys would be there. The seller needs to sign some documents. However, the seller could pre-sign the documents, so they may not even be there. It may just be you and your attorney. Many loan officers, of course, attend to make sure that all the paperwork goes smooth. So your loan officer may be there, and then the title company will be there representing the lender to make sure that all the paperwork's signed and everything. Not only do you sign the documents to transfer title, but since you're not paying cash for the house, you have to sign your mortgage, your note, and all the documents required by the lender. The whole process, if everything goes smooth, is about 45 minutes to an hour, and you can own your house. Go again with things that happen at the closing. The buyer will provide a check for your down payment at that time. The lender will wire the money in for the rest of the value. The seller will sign over the deed. After everything's signed and the lender approves all the documents, make sure you initialed everything and signed everything correctly, the seller, whether in person or symbolically, hands over the keys and you now own a house. And that's basically the entire process. I want to highlight the do not list. When you're working on with the lender, you're going to work with a loan officer. You're going to work with a processor. There'll be an underwriter involved, although you probably will not be talking to the underwriter. There'll be a closer involved, which the title company and the realtors may talk to. You probably won't get much involved. But it's a team of people that put together the whole thing for this to happen. I can tell you from 35 years of experience, the team of people wants to make sure I tell you about this do not list. Because a lot of times customers, although they may know not to do some of the things, they do anyway. So we're going to quickly hit on them. Do not make any large purchases on your credit cards, especially if you've already been pre-approved. It could change your pre-approval. So yes, you're going to need to buy furniture, and yes, you got to do all those things. And certainly, we're not suggesting don't make any purchases on your credit cards, but don't make any large purchases on your credit cards. If you need to make a purchase of furniture, do it after the closing. Do not open any new credit cards or installment loans, like auto loans. I have a client right now that we got pre-approved. Everything's going fine. We checked credit again because the credit's good for 90 days. This one happened to go over 90, so we had to pull credit again, and she had a brand new $700 car payment. That affects your ability to qualify, even though, yes, you're pre-approved. Well, you're not anymore. So you don't want to be making any large installment loan purchases. Credit cards, new credit cards, unless you're being advised to establish new credit, you don't want to be opening anything new either. Making large deposits into your bank account, it has to be documented. We're going to ask. If you put in $5,000 and you normally don't make $5,000 deposits, they're going to say, where did that $5,000 come from? Because we need to verify whether it was borrowed money or if it was a gift, or a lot of times you put the money in, it's perfectly acceptable, but we need to ask where it came from. This one should be obvious, but being that you're qualified based off your income, please don't quit your job. because we kind of need your income. So that's your do not do list. You need to make sure that you keep, for the 30 days it takes to go through this process, 30, 60 days, whatever it is, you want to try to keep everything status quo. Okay, there's a little bit of my contact information, of course, if you do have any questions, and we'll go through some questions and answers if there are any today. But there's my contact information, certainly. Please feel free to contact me either via phone or drop me an email. That's the legal stuff that we have to throw out there, so enjoy reading that. And then, as I said, this is the first of 6 webinars that I'm going to be putting together. You guys are my premier one, so certainly I'd love to hear your feedback. I will be sending out a SurveyMonkey survey after, just to get your opinions. But the next one is going to be on debunking your credit score. It'll be on Tuesday, April 30th at 7 p.m. To register, it'll be the same website. Obviously, the website will have to be updated overnight because right now it's set up still for today's webinar. But sometime tomorrow that'll be corrected and it'll be set up for the debunking your credit score at Tuesday, April 30th. And basically, what we're going to be looking at, everyone knows what a credit score is. Everybody wonders why. You go online for the free one and it's different than the one we pull. And we're going to go over all that. We're going to go over how to improve your credit score. We're going to go over, some of those things just to help you out, to give a better understanding of what good credit is, what lenders are looking for, so on and so forth. So that'll be the next session, which again is coming up in 2 weeks. Now, if I can pull up here, here we go. All right, let's just quickly see if we've answer a couple of the quick questions. First one, how long does it take for the pre-approval process? That's a good question. The pre-approval process, technically 24 hours, 48 hours once you have everything in. So if it takes a week or 2 to gather your tax returns, your pay stubs, and so on, then obviously it stretches out the pre-approval process. But basically, we gather everything and then go to underwriting, and underwriting is 24 to 48 hours. Another one is it worth spending a little more for an inspector? I certainly would interview your inspectors. I know that, because again, as a lender, we don't require a copy of it. So I really rarely see an inspection, to be honest. Your realtor would be more involved in that. But I would interview your inspector to see what you're paying for and what you're going to get. I'm 100% certain there's a full range of, yes, you can get an inspection for a couple $100 that doesn't give you much information versus maybe investing $300, $400, $500 and you get a thorough inspection. So, and then for you need to decide which is the one you need. Again, if, going back to my car story, if you know how to fix your own car, having a mechanic look at it might be less important. If you know about houses, it may be less important. If you don't know about houses, you may need an inspector. Normal closing costs, excellent question. It depends on where you're buying as far as the transfer taxes and everything else. What you're going to run into is closing costs, are lender fees, escrows, or what we call prepaids, and title charges. Lender fees are what the lender charges. Call them junk fees. That's what we used to call them in the old days. Prepaids are to set up and establish your escrows for your taxes and insurance. And then title charges is what the title company charges you to transact to insure the house and transact it, or insure the title and do the transaction. The lender has no control over your title charges. We're not the title company. So we give you an estimate of what we think the title charges will be, but in all reality, it's an estimate. We know what our charges are going to be, so that when we tell you what our charges are, that's what they're going to be. And the prepaids vary on your taxes and insurance. The actually ties to the next question, which is, am I allowed to ask the seller to pay for closing costs? Everything's a negotiation, and that's why you want to have a good realtor. Certainly, the seller can pay your closing costs. If you negotiate it into the purchase price, the seller can pay your closing costs, which will reduce what you need to bring to closing. And that's a future topic also about how to buy a house with less money down. And that's one of the tricks, is have the seller pay your closing costs. And then the final question here, who prepares the documents for closing. From the mortgage standpoint, or the documents to secure the loan, the lender does. We send it to the title company. The title company represents us through the transaction at the closing. As far as the deed and everything else is concerned, normally that would be done by attorneys. Again, there are certain areas like Rockford where attorneys are not regularly used, and so either the title company or the realtor will do that. Neither of those two are attorneys, so therefore they're not technically able to legally represent, although it's legal to do, but they can't give you legal advice. So again, that would once again reiterate why you'd want to spend the money for an attorney. That's why I really feel that it's a good investment. It's not an expense; it's an investment, so that you're getting a clear title and keeping the transaction on upfront for you. So, if there's any other questions, certainly I can answer them. Or again, you can send me an email and or give me a phone call, and we can take it from there. Otherwise, I hope you enjoyed today's webinar. I'm trying to keep, we went 6 minutes over, so I'm trying to keep it to 30 minutes. I promise I'll try harder on the next one, and I do hope I see you on Tuesday, April 30th at 7 p.m. With that, good luck and have a great evening.